Hello traders, welcome back to new video in our exciting series. I am Sanjay from Tribe International and I am thrilled to continue this journey with you. Tribe Hub, where financial empowerment begins. This session is powered by Tribe Hub, a place for all financial education, an initiative by Tribe to empower traders with knowledge, tools and community support to excel in the financial markets. Every market experiences different phases, primarily categorized into uptrend and downtrends. An uptrend indicates a period where prices are generally increasing, driven by optimistic market sentiment and investor confidence. Conversely, a downtrend signifies a period of declining prices, often caused by negative sentiments and selling pressure. Understanding these phases is crucial for making informed trading decisions. Today's video topic is in continuation with the last one, which was multi-time frame analysis. We have made this series more focused on technical analysis and chart reading to help you identify good Forex trading opportunities. So let's get started. Video part 1. In this part, we will understand what are trends and how to identify them. Let's understand it with market phases. First of all, market phase are of two types. First is trending and second is consolidation. So in trending market, the market is moving in a single direction where the direction of price movement is pretty much clear and obvious. Here you can see on this chart the market is moving in an uptrend only, means direction of the trend or price is going to the upside. Here you will find more green color bars instead of red ones because the market is moving with a very good momentum, and we will call downtrend also a trending market. So trending market can be both uptrend or downtrend because in both of the trends the direction is very much clear. And the second phase is consolidation, where the direction is not there, means the market is moving in sideways type of situation, neither up neither down. So in consolidation phase there are two segments, which is accumulation and distribution. So both look like a range bound scenario only. The market is not moving in any direction. You can see here also the market is moving more zigzag here and it's not going anywhere. It's just trading flat inside this tight trading range. You can identify consolidation phase very easily by looking at the ranges, but identifying those ranges are accumulation or distribution. This is the main thing that you need to know before you initiate a good trade. So whether this range is accumulation, the distribution range, there are very thin differences between both of them, and we will look at the characteristic of these in detail in later sections. So let's see how does trends look like. So in trend analysis, the trend is the overall direction of the market, in which direction the market is moving. So the market can move, as we have discussed, it can be trending. So trending can be on the upside and downside also. So these both are trending markets. And the second scenario which we have discussed is consolidation, which can be sideways market, neither going up or neither going down. You can see the uptrend is going on with higher highs and higher lows. Each time the market forms a new swing, it forms higher highs and higher lows in an uptrend. And in a sideways market, the market is not forming any new higher highs or higher lows or something. Both are at the same zone and the lows also are at the same zone. And there are some variations of sideways market which we will gonna discuss. But the downtrend looks like this, which is forming lower highs and lower lows. So you can identify downtrend with denoting these lower highs and lower lows structures. Alright, so the market cannot move other than these two ways. First is trending and the second is sideways. Sideways will be also called as consolidation market. And we know that market moves in trends and trend moves in waves. The market cannot be moving up in a single line or it cannot be moving down in a single line. It will gonna be more likely to be a zigzag type of scenario where price moves a little bit up, then form a pullback, then again moves up, then form a pullback, then again moves up. It will gonna have zigzag waves like of structure. You need to remember it. Okay, now we will discuss types of bull trend. So the first type of bull trend is strong trend. Strong trend are also called as breakouts, and breakout very good momentum in it. There will be no pullbacks. It will gonna be moving in a single line, right? You can see these momentum bars, very big candles are forming in the upside direction, and the red color bars are very few. 1 or 2 bar pullback is there, and the market is moving with a very high conviction. And you can see here also this red candle has moved down toward this low but not able to hold this low, and the buyers came in and they moved up and at the end closed the bar at the opening price, right? So this is how strong bull trends look like. These are breakouts on higher time frames. So here only buyers can make money. By short selling, any seller cannot make money at all. Only buyers have the edge here. Even it have a very small pullbacks, the sellers are not able to make any money here. Only buying have the strongest opportunity available in the strong trends. Then pullbacks are very weak and they last only 1 or 2 bars, and probability of higher prices are very high. So is the risk because stop is so far. So what is the meaning of this? Higher probability of higher prices is that it will gonna continue its uptrend with good momentum in the upcoming future also. But risk will also gonna be very high in this situation, because you can see whoever has bought this breakout will gonna book their profits at some level. And if you initiate your trade at this breakout, then you have a very good trade setup going on. But let's say if you have initiated your trade at this level, then your stop loss is just below this swing low only, below this breakout level. So your risk for this bullish trade is very high. Your stop loss is very far away, and if you initiate it here, then also your stop loss is all the way down here only, because there is no significant swing low forming. And in these strong bull trends which do not have any pullbacks in them have higher probability of giving strong down moves also. Because what will gonna happen if you have initiated buy order here, you are riding this up move, and what is happening is your unrealized profit is at risk. This M2M, mark to market profit, is at risk of losing in case of any strong reversals. Because when everyone is going to book profit at this level, then this pullback will gonna be very much strong and with very high momentum. So strong trends or breakouts are a good trading opportunity in the direction of the trend, but you need to take entry at very good levels with good risk to reward ratio. Otherwise the risk of losing or the risk of losing big money will gonna be very high in such strong trends. Second type of bull trend is healthy trend. Why healthy trend? Because it have reasonable pullbacks going on. It is a tight bull channel. So you can see on this chart the market is moving up. From this point it is moving up, but it is forming 4 to 5 bars of retracement, and then again continuing its up move, then again 4-5 bars of small pullbacks are going on, and then again moving up, then pullback, then moving up. So what is happening? Whoever has bought here, so weak players might book their profit and form this pullback. Then again this up move formed up, and whoever has bought at this pullback may book the profit around this level. So unrealized profit are getting capitalized. So the risk of losing unrealized profit is less in comparison to these strong bull trends, and these pullbacks are offering new entries for left out players. And if you look this particular chart on higher time frame, then it will gonna look like a strong breakout only, but it have reasonable opportunities and profit booking going on along the way. So proper formation of higher lows and higher highs is going on here, which will gonna help you move your stop loss or plan your new entries in those pullbacks. So let's say you have bought at this breakout here, your entry is this, you have seen that the market has moved till this level, so your initial stop loss was this, but you can easily move this stop loss if you have find that this is the swing low formed here, right? Then again the market has moved up along the way till here, then you can easily move your trailing stop loss to this level. So it is reducing the risk along the way and helping you ride this bullish trend till its end, right? And the pullbacks here last couple of bars, means in breakout there is only 1 or 2 bars pullback is going on, but here we have reasonable pullbacks bar, like 4 to 6 bars are there for a pullback, and these are not actual pullback, they are just pauses, they are just brief pauses for the new players to enter in and for the existing player to get out to book their profits. Alright, and the probability and risk are moderate cause you can use swings as stop loss as we have discussed. And when the healthy trend is going on in the market, it will give you a reasonable probability that it will gonna last longer in the market. It can persist for upcoming future also, as the market participants are perceiving it as a good opportunity to go long here, and sellers cannot make that much good money in this bullish uptrend because the pullbacks are very slow and very small, but the scalpers can make few points here. So make sure you should not initiate any short entries in a strong trend, or you should not initiate any big reversal trade in a healthy bullish trend. If your view is to just scalp few pips out of this trend by shorting, then you can initiate a very short duration trend. Otherwise, just skip short selling in these both of the trends. Next is weak trend. Weak trend will have a reasonable opportunity for both of the players to make money. Here bullish channel is going on, but this bullish channel is bit wider than the healthy trend. Means you have a reasonable up move, then it has given you at least 75% retracement here, then again move up, then a good retracement, then again move up, then retracement, moved up, then again 75% retracement. So both the buyers and sellers can make money in this channel. Alright, so the buyers are not that much aggressive here, and if you just look at the candlesticks on this particular chart, you will find that the buyers have edge, because you can see the general direction of this trend is only upside. Overall the price is moving on the upside only, but sellers have reasonable opportunity by short selling these resistance levels. Pullbacks are strong enough that it looks like a short-term downtrend. If you look this particular leg on one time frame lower, then you will find it as a good opportunity to short sell, but still the momentum is not with the short sellers. Means you can see the size of these green bars is bigger in whole of the chart than these red candle bars. So sellers are very few, but still they can make some money. And the probability of new swing highs or new swing low is equal. As you can see, it have a very good structure defining support and resistance levels. These support and resistance levels are dynamic in nature and rising with the time. So this resistance has risen up. Now again, when this resistance got hit, the price have moved a little bit up from the previous swing high. So it is a wide bull channel, okay, and it is good to buy pullbacks, but you have to study the price action of the pullbacks, and you will have reasonable signals whenever this trend is going to change its direction from this point. Make sure you do not buy any extended bull channel, means these touches are around 7 to 8 touches already happened in a channel, and then you are trying to buy this pullback. Then it might just form a lower high and starts to decline and give a breakdown below this previous swing low. We will gonna see it in the example, but you should not buy in an extended bull trend, but buying these opportunities will be very good. So we have discussed three major types of bull trends. Here a strong trend is a breakout, you can only buy. Healthy trend is very good to trade in the direction of the uptrend, and the weak trend is good, but you need to take entries at good locations with studying pullbacks in detail. Now let's see what are the types of bear trends. So similar to bull trends, there is a strong trend which is breakdowns. So you can see here the breakdown. This is a reasonable range formed up. A reasonable range formed up. It can be called as a symmetrical triangle, and on the breakdown it has given a momentum downside move with a very slow and small pullback for 1 to 2 bars only, and then again continued its momentum down move, right? So you can see whoever has short sold here might book it profit at some level because there is no big pullback coming in, so the profit booking is not there. And you can see what I had said to you in the strong bull trend scenario, that strong reversal can happen in these strong downtrends also. So this reversal can be brutal because the unrealized profit is at risk. So anyone seeing that this is a very good support level, and if all the players are starting to book their profits, this can trigger a very sharp up move also. So you need to be cautious here that you only initiate trades at the good entry levels only. So only bears can make money. It's a very strong down move and healthy bear trend. It's a tight bear channel and it have reasonable pullbacks going on, okay, but it is just a breakdown on the higher time frame chart as we have discussed in the uptrend section, and it is good downtrend, but along some profit booking is going on the way. So here initiated a short sell which have some brief pullbacks going on which are lasting few bars and then again continuing its down move, right? So you can see here how these pullbacks are offering you new entries. You can always initiate new trades on these pullback resistances, but at some time this trend will gonna change its direction, although it is healthy, but you will get reasonable signals of trend reversal. As you can see on this chart, we have these two candles showing a very good rejection from the downside, means sellers are trying to move the prices down, but they have pushed the prices from the same level, makes it a very good demand zone. And from there, if the candles are able to close above this previous swing high, then you can say that it has some signal of trend reversal. So you should not initiate new trades on these pullback because you have a double bottom formed up here, right? So this is how you need to trade tight bear channels, and probability will always gonna be high when you sell in these healthy bear trend. Buyers cannot make money, only scalpers can make money by taking few pips of target in the bullish direction, but sellers have a very good opportunity short selling in this downtrend. Now, weak downtrend or a broad bear channel, where the overall direction of the price movement is on the downside only. You can see the trajectory of price movement is going on the downside, but the speed is very slow and it is forming reasonable retracement, which can offer buying opportunity for both of the players, buyers and sellers. Buyers can make money by buying these support areas and sellers can make money by short selling these resistance areas. And weak trends are kind of trends which have shown extended down move. As we have discussed, that trend can change their direction, right? So weak trends are at greater risk of changing direction and converting into a uptrend if the prior trend is downtrend. So this is weak downtrend. If you are short selling breakdown of these previous swings low, then the profitability will gonna be a little bit risky here because pullbacks are very wild, right? Let's see how these weak trend convert into trend reversal. As you can see on this chart, we have a very big bearish bar forming up here, a reasonable pullback, then a second leg down around this support area. Then again, it moved a little bit up where scalpers would be able to make money. Then again, price fall towards this demand zone because you can see 1, 2 and 3. This is a very good demand zone for the price. Then price bounced from this level. Then again, new players came in and they short sold this resistance level and price moved sharply downwards towards this demand zone. Then again it moved up, right? But this down move from this retracement, from this pullback, whoever has short sold from this level might not hit its target here because it has already started to reverse from the middle of this channel only. So the price has reversed up, a small pullback. This has formed a higher low. This is lower low. This is also a lower low. So this is lower low, but this has formed a higher low swing here. And this is again a new minor higher low formed up. It has broken out its dynamic resistance area and started to form this range, which is around this resistance line, right? So this is a very good resistance formed up, a horizontal resistance form up, and it has formed more range around here, trapped few short-term players. Whoever is trying to trade breakout, trapped a bit, hit their stop loss around this level, but not able to make new lower low. All of these swings are forming higher lows, and when it penetrated this resistance area, it moved up robustly, and this weak trend has been converted into the uptrend, or you can say it is a very good momentum up move or a strong bullish uptrend, right? So you know how these weak trends have greater risk of reversing into a new uptrend or vice versa. Alright, so this is the three types of trend that we have discussed till now: strong downtrends, breakdowns, healthy trends which have reasonable pullbacks. Only sellers can make money in healthy trends, but scalpers on the buying side can make small money, and the weak trend where both of the players can make money. So anyone who is starting out needs to find a healthy uptrend or downtrend to initiate their entries on the pullbacks. That will be very good strategy to deal in such market conditions. Video part 2. We will understand some techniques to identify these trends and how to deal with swings. Techniques of identifying trends. Here a very good healthy uptrend is going on. It have started its up move from this level, a reasonable pullback, then again up move, a flat correction. This is just a pause. This is not a correction, this is just a pause because the market has not been able to move down below 30% of this total up move, right? Then again an up move, and here the sellers are trying to sell, but they are not able to overcome the buying pressure, right? And only a small profit booking and accumulation is going on, because you see rally, base, accumulation, and then again rally. So we can say that these brief pauses are just accumulation phases going on. So how to identify these trends? What are the techniques to identify them? First is, we have already know by using swing highs and swing low points. So this is an uptrend, you need higher highs and higher low structure. So this is a higher low than the previous one, then this high is higher than this previous high. So you can say, of course, this high is higher than the previous high. So we are denoting it as HH, higher highs. Then again it has formed a higher low because this low is higher than the previous low, and this movement and this pattern of higher high and higher low is going on and on. So we can say there is an uptrend going on. So first technique is using swing highs and swing lows. And similarly, you can identify downtrend with the help of lower highs and lower lows. A downtrend is going on like this, a downswing, then a pullback, then again a down move, then pullback, and then down move, then pullback, then down move. So how will you denote it? So this is a lower low, and in comparison to this low, this new low is more lower, right? So we will denote it as lower low, and this high is lower than the previous high. Let's say this is high and this is just a low. Okay, this is high and this is low. So this high is lower than the previous high. So you will denote it as LH, and again this is a low and this low is lower than the previous low. So this is a lower low. Again, is this high higher than the previous high? No. So it will be called as lower high only. Very simple. Do not get confused in this lower high, higher low, lower low structure, right? Make it very simple. Ask just one simple question, that is this particular high is higher than the previous high? If the answer is no, then mark it as lower high. If the answer is yes, it is higher like this, then you have to mark it as higher high, right? Very simple. So this is lower high, lower low, lower high. So this is a downtrend going on. This is how you can use these swings. The second technique is trend lines. Draw trend lines by connecting two highs or low point. So how we can draw a trend line? So we know that by connecting two lows in an uptrend, we can draw a very good trend line like this. And in case of a downtrend, the movement will be like this, a down. So you can draw a trend line by connecting these swing highs here. The next technique is using moving averages. Moving average is a very good trend showing indicator, where you will find it like this. So moving average is moving in an upside trajectory in an orange color line, you can see. And we have discussed about moving averages in detail in our Forex indicators video. So you can get an idea which moving average is good for identifying mid-term, long-term or short-term trends, right? And by looking at the naked eyes only, you can see that this is an uptrend going on. Markets have inertia. What does it mean? Let us understand with an example. You have heard about the first law of Newton, which says if anything is at rest, then it can remain in rest, and if a thing is in motion, then it will remain in motion unless and until opposite force is applied. So this is true for trends also. Here you can see this uptrend is going on, right? So market also follows that particular rule, which have, if an uptrend is going on, then it will gonna remain in an uptrend unless and until any opposite force is being applied. Market tends to continue what they have been doing. And by understanding this rule, we have identified that 80% of the reversal attempts fail in a good trend, and we can see it as a very good healthy uptrend going on. And you can see each of this pullback is an attempt to reversal. Sellers are trying hard that they want to short sell at this level in an anticipation that the market should start a new downtrend. Again a new pullback, and it was an attempt to reverse the trend direction, because you see both of type of players are participating in the market, buyers and sellers. If one person is buying and other person is selling, both have different views. The buyer wants to keep market moving in the upside direction to make money, and whereas the sellers are thinking that they need to change this trend's direction to make money, right? Both have different view, but here you can see each of the attempt by the short sellers is getting failed because of the inertia the market is having. The market have inertia on the upside in this particular trend. This is why each of these reversal attempts are getting failed. The big question is, when the sellers know that this is a very good healthy uptrend is going on, then why they are even trying to short sell at these highs? Why they are doing it? Because you see, market moves with psychology, and psychology is you have entered a long position at this level at the start of this uptrend, then your stop loss is just below this swing low, so your risk is very low and your potential for up movement is this much. But if you have missed in participating this up move, then what they will do is psychologically they want a very minimum risk for a big reward. And you can see this is a very good swing high formed up here, right? So when they are short selling at this swing high, then their stop loss is just above this swing high. The risk is very small in comparison to the profit target all the way down here, right? So they are initiating short sells on these swing highs in an anticipation of a very good downtrend. Because the risk is very low, the probability will also gonna be very low only. The probability is with buyers as of now in this uptrend, because you see the market have inertia, and whoever is buying at these levels will have to put their stop loss below this previous swing low only. So the stop will gonna remain at this same zone irrespective of their entry prices. So see, this risk is very high on these levels. So anyone who is late in this trend will see this as a very big risk. So they will not buy in this uptrend. Instead of buying, they are trying to short sell these pullbacks. But as we have discussed, market have inertia, right? So 80% of the reversal attempts are failing and stopping out those small players or weak hands. This is how the market psychology works, right? And you can see in this downtrend also, all of these pullbacks are an attempt to reverse the market trend from downtrend to the uptrend. But all of these attempts are failing because of the market inertia. And we will have reasonable signals if the market is actually reversing. Let's say this is a supply zone in this uptrend, and on the second attempt of breaking this previous swing high, if the market fails to break this swing high, then it has formed a double top here, which is a major reversal pattern, and price started to decline from these previous swing lows, then you can say that the reversal is on the way and enough opposite force is being applied on this trend. Otherwise, if the strength is not that much big, then the market will gonna continue forming new higher highs and higher lows. True. So here also you can see a strong reversal has attempted by the buyers, but this previous swing high has holded this particular price level, and short sellers came in and they started to short sell with very good strength. So that is why this reversal attempts is being failed because of the market inertia. So always keep this rule in mind while trading trends. And remember the rule, if the risk is low, then probability of success will also gonna be not that much lucrative. And if the risk is high, then you might have a chance there. So as a trader, what we need to identify is those locations which have high probability plus low risk area. So these opportunities are very few, and these are the only real opportunities available in the market where you can take minimum risk and make maximum amount of money. So try to align these two factors together to initiate a very good trade. Now, basic terminologies used in trends. First is, in this chart we are seeing multiple types of movement going on. Whatever we have discussed now in the uptrend, downtrend, consolidation, how we will gonna identify it on the chart and how we will read it, we will gonna see in this slide. So you can see this is a downswing. This down move has started from this high and ended till this low. So this is one downswing. And in this downswing, we have two down legs. So this is one down leg with no major retracement, but this is a major retracement formed up. So leg one down, a pullback, and then again a second leg down. So this is one big swing, and in that particular big downswing, we have two legs down and one pullback. Two terminologies we have understood: downswing and leg. This is a reversal happened from this point. The price moved up in leg 1, then a pullback, then leg 2 on the upside, right? So this is one swing up. Then it has started to form some kind of range here. So you can see it as a range bound market, trading range. Consolidation phase has started. We have discussed about fractal nature of market movement in the previous video, which is multiple time frame analysis. So there are trends within a trend. So this is one big downtrend, and inside that we have multiple trends going on. If we shift to one lower degree, so this is two leg up in this upswing and one trading range, and then again it has given a upswing after this range. So if you look at the overall picture, then this is the big upswing going on from this low to this high. This is one single trend on the higher time frame, but it have multiple trends inside it. By using these terminologies, which is downswing, upswing, bull leg, bear leg 1, bear leg 2, trading ranges, minor ranges, upswings, swings low, swing highs, right? You can denote each and every movement on the chart with a rationale, and you can easily read and make conclusion out of it. If you are using this practice of marking each and every movement with different terminologies, then you can easily understand what the market is doing, what the psychology is going on between mass traders, and how they are perceiving the next moves. Before decoding this whole slide, the naked chart was looking too much confusing, and we were not able to draw that much of conclusion out of this naked chart. But if you divide it in segments, if you denote it with their terminologies, then it will gonna help you a lot in identifying good trading opportunities out of it, and helps you understand the major market psychology. Alright, next is how to do swing analysis. Defining swings is very important in the market to identify uptrends, downtrends, or sideways market. So are you identifying swing highs and swing lows right? Because we need minimum 5 bars to form a swing high or a swing low, and this is where most of the player fails to identify real swings, and they put up stop losses at random levels that will gonna hit very frequently, and then they will gonna blame the market. But if you are trying to identify these swings correctly on the chart, it will gonna increase the probability of not hitting your stop losses too frequently, and it will gonna offer you right entry prices. Alright, so what are the structures forming in 5 bar requirement to form a swing high or swing low? So you can see this illustration here. We are marking a swing high. So the trend will be like this. Previous uptrend is going on and the highest high bar has formed, and after that, so this is normal price action going on, an up move. We do not have to focus much on these 2 bars, but we need to identify the highest high bar first and then look for the next 2 bars, that what they are doing. So these 2 bars should not cross. These 2 bars high should not cross the highest high bar, okay, and they should close below the highest high bar, 2 bars at least. So then you can mark this particular high as a swing high. If this structure is complete, then this is a very reliable swing high. You can see middle bar must form a higher high and higher low, means the uptrend has continued till now, and the next 2 bar should have lower highs, means these highs should not be moving above this higher high candle. Alright, and similarly in the swing low scenario, the market is in a very good downtrend and this lower low candle has formed, okay, it has also a lower high. Then the next 2 bars should not form a lower low in its lows, means they should be higher low than the lowest low candle. So this is a 5 bar structure going on. To mark it as a swing low, let's say this swing low is formed in this big uptrend. We have seen that this is a good swing low formed up, so you can move your stop loss from here to here if this pattern is completed, and that will gonna give you much more reliability, that it will not gonna hit your stop loss. And if it has crossed or closed below this level, then your trade has lost its potential to continue the up move, right? So this is how a swing low is formed on the chart correctly. One variation is there. What happens if both of the candles, this one, the lowest low candle, and the next candle has formed the low at the same price? Then this green color bar, the first green color bar, will not be counted, because if the first bar after middle bar has same high or same low, then it will not be counted in one of the 5 bars, means now it need one more bar to confirm this as a swing low, because we need the next 2 bars from the middle one. We need next 2 bars to form higher low structure, okay? So this will gonna require 6 candles to form a reliable swing low or swing high, okay? So this is just a variation. Now I think you have a pretty good idea that how you can identify correct swing highs and swing lows in the market. Alright, moving ahead, so let's see what is the difference between a high and a swing high, or a low and a swing low, because most of the players get confused between a minor swing low and a swing low. So let's understand with the help of a illustration. You can see this up move has started from this point and a pullback has occurred. So this point has marked as a high price, or this is a high formed up here, okay? When the market crosses above this previous swing high, it has marked this low, pullback low, as a swing low, because we are trading above the previous high. So it has taken out the previous high, and this makes a swing low, a reliable swing low. Now see this, a new high has formed at this level, right? But you see it has formed this low, but this low, is it a swing low or just a low? As of now, if we are seeing the market has reversed, tried to reverse in this leg. So is it a real swing low or just a low? See this. So this is just a low because the market has not been able to penetrate the previous high level. We will only consider this point as a swing low because this previous high level has been penetrated by the market, but here there is no break of current high has been done. So this both of the lows will be counted as lows only. They are not swing low. To make it swing low, the market needs to move above the previous high, and you can see if you were considering these low points as swing low and moving your stop loss around here, then what will gonna happen? Again a new low has formed. It can hit your stop loss. That is why we have understood the correct identification of swings in the previous slide. And again, if you have considered this low as a swing low, then it will gonna hit your stop loss in this minor down move, and then again it moves up in the direction of your trade. So to avoid that particular thing, you need to wait for the proper swing low to form. Don't just move your stop loss on simple minor lows, because they can still break and still the up move can continue, right? So this is a actual low, and this was on the line chart. We have understood. Now we will understand what is the differentiation or how it will gonna look like on candlestick chart. So how to know when low becomes swing low? So you can see a simple up move has started and a retracement has occurred. So this point will be marked as a high level, right? Then again a up move has started. It has broken above the previous swing high. So will it be considered as swing low? We are talking about candlestick view. According to line chart, it can be, but on candlestick there is a slight difference when we are talking about candlesticks. So will it gonna be a valid swing low if this price has been broken? No, because you can see there is one simple rule that this has moved up, then again a pullback has occurred, right? So what is the variation? The variation is the price needs to actually take out the resistance area, and we have one simple rule to take out the resistance area is that we need one single candle to close above the resistance zone. So you can see here this candle has not formed totally above the resistance area. It has started at this level and moved up and closed above the resistance area, but we need one candle to form above the resistance area. So this candle has formed and closed above the resistance area. So you can say that now the resistance area is cleared out. The buyers have pushed the prices to the upside. They have did their work, but still the sellers can come into the market and push the prices down here. But the next candle has closed above the resistance area, so we can perceive it as sellers are weak here and they were not able to close this candle below the resistance area again. So now we are keeping it as a resistance area cleared zone. So now you can keep this point as a swing low. In candlestick, only penetration, only break of previous high, we will not conclude it as a resistance clearing out. We need one candle to totally form and close above the resistance area. Then we will consider it as a valid break of resistance. So if you just put up this condition, then you will gonna reduce a lot of fake breakout signals also, and you will identify only major swing lows. So this is how you can differentiate between a low and a swing low. So earlier it was just a low, but now that the resistance area is cleared properly, you can consider this low as a major swing low forming up here, and you can move your stop losses below this previous swing low levels. Alright, so I hope you have a very good idea around trends, consolidations and swing identification, and of course using terminologies to mark price movements on the chart like swing lows, bull swing, bear swing, leg 1 upside, leg 2 upside, right? So that is all for this video on market phases. We will cover a strategy on bar counting method in the next video. Make sure to subscribe to our community channels to stay updated and to get amazing offers visit thrive.com. Thanks for sticking around. If you found this video helpful, there's plenty more to come in our series on Forex and technical analysis. And don't forget, for all your trading needs, visit thrive.com. For more in-depth trading education, head over to thrivehub.com. Thanks for watching, happy trading, and I will see you in the next video.